Hello, everyone. Before we begin, I want to recognize the fact that I'm not Jill Richmond. Um, Unfortunately, Jill was under the weather, and then we also had Jessie Draper, that was one of the panelists. I mean, she couldn't make it because she was directly impacted by the fires. But today, I think we're going to talk about a subject that probably every doer, dreamer, deal maker in venture capital world needs right now, and that is about navigating early stage investing. I know you're a little bit more growth, but it starts with the early stage investing. Um, in the early stage investing in the venture capital world, success doesn't happen incrementally; it just comes in exponentially. And there is one law that is above all, which is the power law, where only a handful companies bring the lion's share of returns. But it is, it's choosing that handful companies, those big opportunities, and the CEO of what thousands, tens of thousands of deals each year is anything but straightforward. So today, I'm hoping that we're going to be able to cut through the noise, uh, talk about some experiences, and hope to give actionable insights. And if you're an investor trying to define or redefine your investment thesis, or a founder that would like to improve their approach, I'm hoping this will be a great conversation because we do really have, and I don't just say it. I mean, three panelists here that have completely three different backgrounds that are investing in completely different stages. I think you know Brian in the middle will be the first one to invest in potentially a company. Then Gary will come in with the seed stage, and then when it's time for Series A, the Brian right here will take over. And they do also have such unique backgrounds. Let me read it so I don't do I don't miss anything important here. But in the TechCon app, maybe not right now, later you can look at the full bios and the company information of our panelists. On my right, Brian Message. Oh, and we didn't even practice. So he co-founded Anona Capital, and I think between the two funds, I might be mistaken, but you were instrumental in raising $250 million for your two funds. And Ancona Capital has a very clear investment thesis. We'll get to talk about that more. But you only invest in growth stage B2B software companies. And before Ancona, you did spend 15 years or more as a general partner at Anthem Venture Partners. And you do also have this interesting experience. I don't know if it played into your investor thesis, but being an engagement manager at McKinsey and Company. Not all, okay. And you have, but you have seen enough, long enough that you probably helped your portfolio companies through a couple different economic cycles, right? Great. So that's Brian for you. We got another Brian, who is the founder of Expert Dojo, and I don't have any statistics, but I'm going to guess that you probably Expert Dojo is the most active accelerator in Southern California, I would assume. And you invest in you have invested over 300 startups, and most of them are founded by either international founders or some underrepresented entrepreneur profile. So I think especially we would like to talk about how you spot these potentials in these unconventional founders. Gary Bennett is the managing partner of Social Leverage. It's an early stage capital firm specializing in scaling tech startups. And you have done, you said, four startups yourself. So you've seen both the investor side and the founder side. So you probably have a good idea of how can you help founders tactically while keeping the big picture in mind. So first of all, thank you for being here. I'm just curious, just so that we can customize the questions. How many of us here are early stage investors? Quite a few. And how many founders do we have here? almost even. Wow, that's great. So I'll start with the same question for all of you. And I didn't give you this one, but I think you should be fine. What inspired you to be an early stage investor? And how has that evolved, that approach evolved over time? And maybe you can tell a little bit personal story with that.
Sure, I'm gonna switch it up a little bit though,
Sure.
if that's okay. So I used to be an early stage investor.
I'm sorry.
No, but it's
Yeah.
good. I didn't know this question, but we're gonna make it work. So it was great, but I'll tell you what made me switch to becoming a slightly later stage investor,
Okay.
which is I spent 15 years being first institutional money in, and it's really hard. And you asked if my work at McKinsey was helpful in helping founders. At that stage, not at all, not in the least. I mean, you need a handful of people building product and trying to find product market fit, and there's almost nothing you can do at that stage, which is part of what led me to want to move a little bit later when there was enough data and enough traction to be able to use pattern recognition and operational experience to actually help founders scale. So it's part of the reason that I moved. And I also moved because early stages is really hard. And back in 2000, before the dot-com crash and then beyond, it was very different. We could reliably find an early stage opportunity, get a little traction, find follow-on money at a nice up round valuation, and that sort of changed over time. I found myself being jealous of the later stage investors who had come in after 5 years of sweat and staring over the edge of a cliff and maybe paying more, maybe paying a little less, and skipping all the hard part. And I also felt that in some ways the early stage power law rule, which really is how venture funds have to work, what I saw was that didn't always, in my view, seem to be in the best interests of founders. There was a mentality of pouring a lot of fuel on a handful of great platform companies, hoping they take off, but if they burned on the launch pad, that's okay, you could move on to the next company. And I didn't think that was really the way to build a business. It wasn't founder-centric. And wanted to do something that was focused more on preserving exit optionality, with a realization that, despite the power law, most companies exit for, good exits, 200, 300 million bucks, and those are hard to engineer. And so we created a firm to invest in companies that were a little bit later stage, where we could achieve our objectives more reliably, but not focused on the power law.
I see.
I hope I didn't just cut your legs off, Gary. And
No,
Brian.
maybe. Yeah. I mean, are you convinced, Brian, to skip from early stage to growth stage after this?
I think they're all fine. My motivation is slightly different. We did this last year in La Jolla, right? Down La Jolla, we had the
Mission Valley. Yeah.
Yeah, and so the first question that I was asked was, I was on a panel at that stage with a bunch of accelerators, and some very illustrious accelerators who do an amazing job. And the question was, acceleration is an important part of the startup ecosystem, and can you tell me why what you're doing is so important? And I answered the question was, I think actually accelerators are overpriced and add very little value these days. Like 20 years ago, accelerators were amazing, but actually everybody in the ecosystem, all of us included, there's no goods, bads, anything, need to really look at the value for equity that's given and take a hard look at actually what's given back to the entrepreneurs. Right? And I meant it then. And so when you say, like this time around, like, why do early stage? Well, my motivations weren't so much now it's math for me. But definitely when I started, I kind of looked at the early stage ecosystem, or just the venture ecosystem. And my thought, as someone who wasn't born here, but certainly feels very much from here right now, was that entrepreneurship has lost its way in a huge way. And that's not the fault of the venture capitalists. It's the fault of the amount of money that is available in venture capital. So when you suddenly have, and this wasn't the case 20 years ago, 10 years ago, best country in the world, like we rocked everything. But now you get some schmuck who gets like $200 million just because their dad just happens to work somewhere. And it's a problem, because what happens is the innovation in the country goes through the floor. Now, I've been like massively encouraged in the last year or so with what's happening with AI and how we're like reclaiming our place in a really huge way. But this has been a decline like this for 10 years in a horrible way. We're starting to call companies like Casper Mattress a tech company, or WeWork a tech company, or this garbage that happened for about 10 years. So my view was, look, I don't get to be the one to fix this, but I certainly get to be one of the ones who gets to fight it. And what I wanted to do is put the focus back on the customer again, have us really focusing on building incredible products that customers desperately need, that will transform the way that they work or live or enjoy, and bring us back to a place where we can start looking at what we're building and not turn it into some kind of mini Ponzi scheme that a 12-year-old actuarist who happens to work for a large venture capital firm is manipulating. And so that's why I started.
What about you, Gary?
Yeah, so my motivation for beginning to invest probably came from the fact that I was on the other side of the table and I was a career entrepreneur first. And when I sold my last company, I had the opportunity to be approached by a lot of founders that wanted some level of the expertise that they thought I had. And so they wanted my advice, but they also, were happy to take my money. And that's what drove me to become an angel investor. And the thing with angel investing is that it's great to meet founders. It's really great to hear their stories. It's, you feel so energized to be part of what they're doing next. But I had an 80-hour-a-week day job, and so I forgot about them right after I signed the check. And I want to be much more proactive rather than reactive when they ask me for something. And so after I left that last company that I was working at, I wanted to invest full time, and I was fortunate enough to partner up with my now partners at Social Leverage. They were actually investors in my last company. That's how I got to know them, and it's been great working with friends and helping the ecosystem grow and really taking learnings from one entrepreneur and applying them to the rest of our companies in that proactive way. I love doing it.
Normally, I don't like asking the same question to each panelist, but because you're all like at the different stages, I mean, what I love to know is, and maybe we can start with you, Brian, since you're the earliest of all. You're being pitched. The founder is in front of you. In your mind, like, what is it that is that first thing you're looking at, that gives you that feeling of, this is the, it's signal for breaking out potential.
So you get a lot of practice with 300 investments, right? Your perspective on what you look at things changes definitely over the years. And we've invested probably 30, 40 companies in India, probably 25, 30 companies in Africa, ton of companies in Europe, ton of companies in Latin America, a lot of companies here as well. So like our perspective is really good. And considering when I came into this space, I came in knowing that if we came in at a very early stage, but rather than studying like a bunch of people who are around me who are investors, actually study the customers and how the customers are impacted. The customers tell everything. They never lie. Yeah. And so they're not in the pitch, but they are in the pitch because you can tell by the retention. You can tell by, how long they stay for. You can tell, like, we'll very seldom come in pre-product. Very seldom. Like, that's for your mom and your dad and your friends. But, like, once you've got a product that's in the market, we're growth hackers. I don't even really identify as an investor. We've invested in lots of companies, but I identify as a growth hacker with a specialization in emotional resonance. And my team and my extended team are growth hackers in other areas. So the second we have a pitch, you see someone who's either not sure of themselves or sure of themselves, and a bias will definitely set in. You'll see a market which is either very big that can grow to something that can do $10 million a month, or you don't, and that will have a bias on you. You look at people that have specialization in areas that can destroy the company or not. So i.e., I'm a biz dev guy. If I'm coming in and I'm pitching a highly technical product, well, I probably don't have a very highly technical product built if there's a dev company outside doing it. So there's certain rules that you have, but like our biggest rule sits around what the customer is doing with the product. If they take it, are they taking more? I'll say one last thing. I had a good friend of mine, a guy called Martin Tobias, who's I think one of the top rated investors on Angel List. And Martin came down, we're up on Santa Monica on top of the mall. And Martin came down to my office one day and he's like, I saw this great company. They have a conversion ratio of demo to sale of 130%. And they are and the founders have got massive experience in the space, and they're having a huge, and their renewals are off the charts. The only question I asked, I didn't ask the market, I didn't ask what they did, I didn't ask anything. The only thing I wanted to know was how many demos they did every single month. The answers are all in the numbers. And in this market that you're in right now, this is not about a lovely story and about talking about where you came from and talking about the birds and the bees and how nice. This is just the numbers. Sell the numbers. The math will take you to a unicorn if the market size is big enough.
I see. Yeah. Gary?
I mean, just a little counter to that is, I'd say that we invest at the same stage as Brian, or maybe slightly later, but I don't know. The numbers at that level are kind of meaningless to me.
Oh, that's
because
good.
it's so early. The product is in its infancy if it's out there. It's like not the product that it will be. Yeah, do we want to know that people are engaging with the product? No doubt. Like, we definitely want to see that. But I don't know, if you've got like 5 customers, is that really indicative of what you'll have a year from now if you're successful? Is that going to be the baseline? So I don't know. I mean, to me, the thing that really stands out, the thing that gets me interested in digging deeper is always the people. Like, the numbers just aren't meaningful enough. And so I want to know about the founders. I want to understand what's their motivation. Are they able to build a product that they envision? Do they have both the long-term plan that's going to really lead them to success, but also the more tangible, shorter-term plan that's going to allow them to raise the additional capital and hire the additional people to eventually get to that long-term success? So to me, it's that first. Now, we're going to get into customers too, but only after I'm really impressed with the founders and their vision and their work ethic and their motivations. Only after that am I going to do the work to understand the market and the customer base.
Like, what about the assumptions about the customers or the customer discovery process? I mean, does that come into play in that analysis of the founder?
Yeah, I mean, I want to ask, like, how did you get to your first 5 customers? Are they all friends of yours, or did you reach them cold? Like, what did that process look like? For sure. But again, like, I'm not going to speak to that customer and find out what their motivations is unless I'm already bought in on what the founder is doing.
Yeah. And,
I might fight Gary a bit on this.
I love this.
yeah, we'll get to the fighting. I think that you might. Yeah.
So here's the thing. I had this guy, Matt, from North, right? And what he was doing was he was taking data for cloud storage usage, and he was doing the same thing as what the oil and gas guys used to do with gas in your homes. And he'd be like, hey, if we reduce your energy by whatever, we take 30% of whatever we save. And so he calls me up. They were at products, they were selling to customers. I'm like, can I do a call at 8 o'clock in the morning? He's going, no, because I cold call from 8 o'clock in the morning until 10:30 in the morning. I do 75 cold calls before I have my first coffee in the morning. I'm like, why do you do 75 cold calls? And he's like, I do 75 cold calls because I know I can get at least 3 appointments from those 75 cold calls. And those 3 appointments, I know I can convert one of those 3 appointments into business every single week. And I've worked out that if I can take 1 sale every single day and I can convert that across with the amount of revenue that I'm going to drive through, that's going to bring me to a place where I can get to $200,000 a month within a 15.5-month period. Like, it was very clear and very easy to me. Is he going to have a Horizon 3 product? Of course. We all evolve our product. Like, that's called listening to the customer. But most people have looked at a bunch of YouTube videos, read a bunch of books, and they sound amazing, and they've gone to school, and everybody's taught them all the beautiful things to say, and all of their friends are out there, and they've all done founders, so they know what to do. And nobody executes. It's the hard work of the numbers that counts. Like, we have so many of these conferences and talks about how glamorous and beautiful and gorgeous this thing is. But the reality is, it's divorce. It's not seeing your kids. It's losing your house. It's mental health problems. It's all those things, because nobody, and I mean nobody, is trained to actually do the cold call outreach and then understand the conversion to be able to take these people home. This is not a pitch deck. And 99% of people aren't in a position to do it. Me for many years, until I learned that there was no choice. So I would rather focus everything on the people who understand the numbers and then have the numbers fail in the future. I'm down with that.
I think you're not
That's
saying
just
so
not
many-
numbers.
Yeah.
That's hustle. You're looking for hustle.
Yeah.
You're looking for metrics that are showing hustle. And I usually like picking the fights, but I'm going to be the bridge here. So
You sure you want to do that?
I'm going to try. No, it's not. No, I'm not sure I want to do it, but I'm going to. That's my opportunity now. So the issue with the numbers is, so yes, hustle is number one, and you want to have a good founder that is showing the hustle. Gary's making the point that the numbers at early stage really don't matter because you can't tell until you try to scale. Your acquisition cost, your magic. It doesn't. None of it's real. So you can't really look at the numbers. You can't care. But what you do have to keep in mind is, as you go up the pyramid, we're very cognizant that we are going to make money by selling our companies to primarily financial buyers. Some of them are going to go public, maybe. Some of them are going to be bought by strategics, but we're going to be selling most of our companies to private equity firms. They don't care about anything but the numbers at that point, and we know what they want. And so we have a very specific, when we're in a company and it's getting to 40 to 50 million in revenue or 100 million in revenue, we know the numbers that we got to hit to get a 10x revenue multiple versus a 5x revenue multiple, and it's really cut and dry. We're in the middle. We're looking for companies that show the promise somewhere past where Gary is investing, that have the promise to get to the metrics that we think that we can sell, because the buyers down the road are extremely disciplined. They don't care about the vision. That founder that scaled the first year or two is probably not making those 75 calls anymore. He or she has scaled a team. So we're very cognizant of the numbers and the potential to get there. We ultimately, though, are making our decisions primarily on the relationship we have with the founder once that hurdle is cleared. I will make 3 investments every 2 years, maybe 4 to 5 over the life of a fund. And so the founders that get traction are the ones that you can see yourself wanting to work with for 5 years and taking a lot of your time over the next 5 years, which is our investment horizon. And it's very personal. I had lunch with a founder and his wife this week as they were in early stage, and that was hugely impactful. Like, I know that founder now. I like him. I want to work with him. He's got a great business. Wouldn't matter if he didn't have a great business. But it's the fact that we had that great lunch, and I can see working with this guy, and I like him, and he's got a good founder story, and there's good product founder fit. Like, it becomes very personal, even when I am more focused on the numbers than earlier stage investors might be.
But the good founders and the good deals often comes with possibly competition. So how do you, Brian, deal with that? Analysis by paralysis or taking time. How do you manage that? I'm not saying you're not, but
no, it is very difficult. I'll tell you what's worked for us. So we are very proud at our firm that we're not embarrassed by anything we did in 2021. Like we stuck to our guns. And, as we've, retroed on all these decisions where we decided to bow out, I don't think there's a single example where we wish we had stretched beyond our limit in order to get a deal done. So we stay disciplined, and we will lose deals, in particular if we are competing against a Sand Hill Road firm who is betting on that $1 billion exit, and that's fine. We'll lose those deals. In most cases, the reason we were able to find good value even in 2021, is because we are younger, scrappier, not younger by age, but younger as a firm, scrappier. And we tend to tear businesses apart to look at the parts that are working well and the parts that aren't, where a lot of firms will just sort of look at the overall numbers. Retention isn't good enough. I'm not going to look at this. But in companies that are early growth stage, they've got a mix of good and bad customers. They all do. Every single one is starting to learn who their ideal customer profile is. And we took the time to tear companies down to understand that, 2/3, 3/4 of this business is great. It's being brought down by a quarter or a third that isn't. And that didn't stop us, because that's what we see as normal. As long as the founder agrees with us that they should focus on the better customers and ignore the others. We get blown out of the water all the time.
Yeah.
And by the way, again, those retros, we were happy to be blown out.
I think this is a good segue to due diligence. We just practically there. In your case, Brian, do you have a special question or a special methodology in your due diligence that is not really gut feeling? Package this, a method?
So yes, we actually. I don't want to be too dramatic, but I should at the same time.
Yeah, you can be.
So there's a couple of things. Number one is the thing I've always wanted to do. This is not due diligence, but it's tied into what I'm about to say. But there's a thing I've always wanted to do, is just to get founders to sign a contract with their significant other with a specific timeline by which they will be achieving the metrics that will show them that the company is breaking through. I've always wanted to do it like a physical contract. It doesn't have to be legally binding, but maybe marriage binding, like the kind of stuff, because it's the worst. Like, we're all founders here. You're mostly founders here. Even if you're investors, you have to get there somehow. And we're the most selfish, SOBs that exist in the world, especially inside family. So I've always wanted to do this. I'm a math guy. I just love math. I think every answer to every question, even romantic, there's an element of math which is included inside the answer, right? So to that point, when I first started off in the dojo, we had it very clear. We're growth hackers. You come to us because you want to grow and because you want to grow fast and because you know you're already dead, and what you're trying to do is try and resuscitate yourself at a time that you have no money, right? And so we're like, cool, we'll do growth. But we didn't measure it properly. And we had great branding people, great personal branding people. We had outbound people. We had Horizon 3 people. We had like a really good program, but we didn't have branding. And when we went back and we looked at all of the companies we brought through, we saw that there was a difference, but not a significant difference happening within their growth because of it. So we stopped it. And we stopped it for a period so we could look at it. And this is to Brian's point, like, you have to continually be evolving, and you can't ever change the way you're going just because you see a market that happens to be changing. Sometimes it's an amazing piece of news that actually gives you an edge in the future. And that took us to where we are today. Today, I'll still call founders by their name, but I think of them as a number. And the number is a unicorn probability score. And that number will then be given. So what we'll do when we bring them in the program, we'll do it in our heads before the program, but when they come in the program, first 2 weeks will be very specific on just making sure that there's no silly investment things that are just missing, all of that. Then we'll put them in a growth program. We'll do the same thing with the branding, do the same thing with the personal branding, do the same thing with the outbound, and we'll put them on a very specific trajectory. We'll then do a GTM specialization where we'll have GTM people who'll be working with them, who'll be going through numbers as well. We'll then measure their percentage. We'll break them into 4 quadrants. First quadrant is percentage growth in the previous year. If you're if you're at 200%, you get 25 points. If you're under 200%, you get a percentage of that. If you're over 200%, you get a percentage plus of that. We'll then look at the coming year, and we look at the probability of 100% growth on your revenue there. How will we measure that probability? Well, we have 7 separate quadrants as well. We have outbound, we have conversion, we have systems, we have peak performance, we have investment, and we have what we call domain dominance, and I think there's something else in there as well. And we look at each of those, and we'll build a score, which again will give a percentage of the 25 points that we'll put in. We will then look at the time period that will take for these companies to get to a Series A. If it's 2 years, then they get 50% of 25 points. If it's 3 years, and so on and so on. We'll then look at the percentage increase of valuation from now to when they get to a Series A. And we'll give people a number. And if you're over 50, we're going to tell investors about you. If you're over 70, we're going to scream from the rooftops to investors. If you're under 50, we're going to tell investors not to invest in you. We're going to say, do not invest. But we're also going to say to you, we have these incredible growth hackers who are going to help you and work with you to get you to a place where the people that you're going to engage with are not going to be people that you owe money to in the future that you can't pay back. I don't necessarily want more unicorns. I just want fewer people failing. And for me, numbers are the direct route to be able to do that. And having that number on day one, on the specific activities that you need to do to get to the place that you need to get there at the end of 12 months is the only way you're going to make it. Otherwise, you just get loads of free t-shirts with your name on it and a few business cards with founder and then just a lot of poverty.
Can I moderate for a moment?
Sure. I mean, I think I'm watching.
Just a quick question as a follow-up. It's a follow-up for Brian.
Yeah.
So have you found, I'm fascinated, you track all this stuff. So what has surprised you in terms of predictive ability in the early metrics in terms of predicting future success? Is there anything that stands out?
I think I just got better at people. Mm-hmm. To your point, like it was what Gary had said it before. I think I got better at people. Like, first of all, none of us like cold calling. Like, none of us. Like, nobody likes getting up in the morning and doing 75 calls. Second, hardly anybody is good at email outreach. It's become so difficult right now that, like, whether you use Apollo or whether you don't, it doesn't matter anymore. LinkedIn, everybody's using LinkedIn. So it's really, really, really hard to market. So I think we got better at marketing. I think we got better at measuring. I think I got better at being able to see people who weren't going to break under the pressure, which is like hardly anybody in those first 2 or 3 years. Like it's a brutal journey to get there. And we got to this place, which actually pretty much what we do now is not based on a Techstars or anything else. It's more based on like a top 5 consulting firm.
Yeah.
It's like you look at all of the things and you're like, here you go, but without the price tag. Yeah.
I mean, do you think, Gary, when the agents are going to be doing all that work, I mean, are we going to be similarly with the numbers again, or what do you think?
Sorry, say it again.
Gary,
You're asking me about
yeah,
agents?
yeah, like, with the new agentic world.
I'll believe it when I see it. I mean, to some extent for sure, but I think that there's going to be blindness to all of that too. So you're going to have to find new ways to reach your customer, and a lot of that might be personal touch again. So we'll see. We'll see what happens. Going back to your
Due
diligence
diligence
question, I think there's a piece about diligence and a piece about one question to find the answer. I think there is a bit of storytelling that I actually fall for as an investor, and I like it, and I think other investors do too. I mean, I could tell you many examples of very similar metrics companies, and one of them gets funding, another one doesn't. And I think it comes down to storytelling in many ways. We want to make sure that we get the right valuation on the way in, because we know that multiples have come down on exits, and so it's true we're shooting for that power law mostly, but we're also very happy to have a $200-300 million exit in our portfolio. There's absolutely nothing wrong with that, as long as you get the right price on the initial investment. But the question that I like to ask to kind of determine whether or not I want to move forward is, what's your motivation? What's your expectation for the company? What do you see as the end state? And really what I'm trying to understand, the answers might be scripted, I don't know, but I'm still listening for how they're answering it. And what I want to know is, are they building a long-term value-generating company? It takes 7 to 10 years to build a company of value. Like, that's the starting point. Sometimes it takes 15 or 20 years. And so, sometimes people are really honest and they say, oh, we're going to flip this thing in 2 or 3 years. Well, that's not an investment for me or most VCs, because you're not building enough value in that time frame. You just don't have the time. Sometimes the answers are different and give you the sense that they want to spend more time, but you just know that their heart's not in it. Like, they don't love the industry. They're not in it because of a personal pain, whatever it is. And that would be kind of the end of the process. But on the actual diligence side, I think it's the things that you would expect. We want to make sure the cap table is clean or can be cleaned up. We want to make sure, in most cases, that they're a Delaware C Corp. We want to make sure that there's no legal situations outstanding against them. We want to get references on the founders, and we want to talk to their customers. We want to do all of that work, but it's after we're already mentally committed to doing the deal based on kind of the initial interactions.
You bring up reference calls. I think that's a good one to maybe ask you about. I'm curious about, like, how do you do reference calls, and if you do it, how do you really get the true answer? Is it what they say?
You're looking at me?
I'm looking at you. Is it what they say or what they don't say?
So this is something that we do really well, and it's and you wouldn't believe this, but we build basically a market map of competitors. We build our own sort of market map, and then we use LinkedIn to find connections on the board, investors in companies, ex-employees of competitors. We build this huge long list, and almost nobody will not talk to you and tell you what they think about things. Even people you think might be conflicted, and you have to be careful. But we do a tremendous amount of calling, leveraging our network to zero in on whether something is interesting or not right from the start, even before we do company-provided calls. And this is something that I think even the later stage investors do better. And I'm not 100% sure how they do it, but a lot of, especially the crossover funds, I think would partner with groups like Bain and others. And they would generate these diligence reports like the one they did for Doug's company, which are amazing. But yeah, no, we do not just call the references provided by the company, before we get to customer references, which are sensitive and we want to protect that.
Yeah.
We leverage our own network and get a 360-degree view of the space, the company, the competition, the differentiation, everything that the company we're looking at has no involvement in.
Are you mainly looking for red flags or green flags? Like, do you think of it like
Mostly
that?
by that point, it's validating a thesis that we've developed. So we will have a set of questions that we're using to validate or invalidate a thesis. And it's not so much looking for red flags on a founder or anything else. It's really trying to get the lay of the land to stress test whether our thesis makes sense or it doesn't, and just give us conviction that we know what the hell we're doing. I mean, that's when we're looking at an opportunity, part of what will screen it out quickly is if it's a space where we think we're really unlikely to get smart enough to trust our judgment to do this deal. So it's really about building conviction that we're not doing something dumb.
And in your case, you're more like B2B SaaS, so you don't really have the technical execution risk, so to speak.
Much less. I mean, there's a lot of tech debt in some cases that needs to get redone, and we stumble on that. But in general, it's not a lot of technology risk.
Yeah. Do you do any reference calls or think of it like that?
Sometimes, but not as often because they're early, right? And to Gary's point earlier on, like you have to be, you're more sensitive with companies early than you are almost with them when they're later. When they're later, they've built up a relationship, they're doing lots of business, they're explaining to their customers whatever's happening. But at the very beginning stages, they're hoping that they just don't leave. And some of their customers don't even know that they're customers. You know, they just know that there's a thing happening that they're paying like, $200 a month for. But if it's, for example, we invested in a company, Matchbook, who are a LA-based company, and they were building deep data AI, and we knew there wasn't AI properly in the product yet, and so we wanted to find out like what some of the folks were thinking. We could go to one or two customers, but what was much better was going to Dun & Bradstreet and Moody's and having conversation with them about how they saw the future partnership. So I think you're looking for it's a different level that you're looking at, but it's always good to check.
And I mean, Gary, in your case, I think your thesis is social leverage is the new financial leverage. It's an interesting thesis. It's a part of the due diligence, and when you're validating your assumptions about a company, how do you go about it? How do you see that social leverage?
Yeah, so it is true that the name social leverage basically means that financial leverage is really a commodity at this point. Like there's lots of sources of capital, but to further your company, you really need the network. And we leverage our network, I think, like most of us do. So first of all, we've invested in over 150 founders at this point, so they're a great deal source for us. But they're also able to vet companies that come in, or they might know the person. It might be a background reference where the founder hasn't given the name to that for us to ask that person, but we see them connected on LinkedIn or what have you, or know that they're both in the New York tech ecosystem. We'll ask questions. Similarly, on the LP side, our LPs are mostly high net worth folks that have made their own money, sometimes in tech startups, sometimes in real estate or finance, but they're all on the ground listening to these things and have expertise in their area, and we bring them in and they provide great guidance for us.
Mm-hmm. I think we're slowly getting to the 10-minute mark. Brian, the Brian right here. Can you give us like both real first-hand experiences of deal missed, that you learned, and let's start with that. Maybe I'll follow up.
We're gonna go like the historic anti-portfolio, like the
what is that lesson you learned when you missed that deal?
So there's a lot. Uber.
Oh, Uber.
Sort of. That's a semi-anti-portfolio, but
what was it?
I declined Travis's prior company, and my partners wanted to invest, and I pissed him off for killing that deal. So we did not see.
Is that why you started the new fund?
No. My partners forgave me for that. But it's really hard to tell early on. We passed the better tour pass would be Anaplan, which is $6-7 billion market cap B2B software company, tremendously successful. And I met him on Market Street in San Francisco in a crummy office with no windows. And I said, well, who cares about Excel in the cloud? It's just Excel. I don't get it. And
so what is your lesson learned, would you say?
I should have known that Travis would be a founder we wanted to back at some point because he's the guy you're looking for in every way. And the real lesson for Anaplan was I was investing mostly in semiconductors at the time and had no idea about software. So I'm much more focused now. It's part of the change in firms was to focus on a place where you could build more expertise. I didn't know what I was doing.
I see. Gary, maybe you, Brian, you can take the last one here. What about your lesson learned from a deal missed?
I'll copy Brian and say Travis too.
Oh, really?
Really?
So Travis's last company and my previous company were both Mark Cuban companies. So we were hanging out. We were Red Swoosh, yeah. And it was Box. It was Aaron and Dylan from Box. We were all hanging out together. The Box guys weren't even 21 yet, so we'd go to events and they'd have their diet sodas. It was great. And then I was building my own company in 2008 and just fell out of touch with Travis and didn't realize that Uber was his until 2010. It was too late. Anyway, that's probably not a venture story, more of an angel story. My partners, actually, let me back up and just say, look, at the seed level, I feel like it's not a truly competitive environment. The competition is us getting to a deal before anyone else and deciding whether or not we want to do it before others even know about it. So really, when we miss out on a deal, it's either because we didn't know about it and that's shame on us, or we passed on it, which happens from time to time. So it wasn't my deal. I wasn't part of the firm yet, but the one that we always reference is passing on Carta. And the reason that we passed on Carta, even though my partners liked Henry and thought that he was a great founder, is because they had an angel investment in AngelList, and they thought AngelList would have the same capabilities and go in the same direction. And so, it's hard to fund another company that will eventually compete with one of your existing investments. Some firms do that. We try to stay away from that. It happens.
I see. That's a good lesson.
Can we do things we love for 2025 and be a bit
Yeah,
like
I was
finish
hoping that in the
strong,
last
like,
couple minutes we will
the only
close
reason
on a
is, like,
positive note. But
yeah,
if you
finish
want
on
to
a
switch,
positive note.
well,
Yeah, only switch because I'm sure there's loads of companies. I can't.
but
think
I
of
would
any.
love to
I
learn.
would've missed-
I would love to
would've-
learn your mistake. Though.
If Travis
yeah.
had spent like 10 seconds ever knowing who I was, we might have had a chance to miss him. At least you had a chance to miss him. Okay, we wouldn't even noticed. So that's even lower. But I don't know. I'm never hard about us or anyone else. We all see stuff. We don't see stuff. To your point at the beginning, things fucking change like so much over a 10-year period that a company is unrecognizable from where it was before. I will tell you what I find to be the most gorgeous things in 2025, where I am like viciously focused on. Number one, India. We just opened up in India. We're going to do tons of investments in India. I love what's happening in India. I'm going to stand outside IIT with a big sign saying, looking for people to give money to, because there's so much awesome stuff happening in India, period. No offense to everywhere else in the world. We look at you, but not that much. India is what we're looking at, like in a huge way. And we want to have that bridge between India and here. The second thing, AI data centers. My partner has a small little city outside San Francisco, and we are going to build a monster, not data centers, AI centers. This is going to be other than food and water, which is obviously disappearing, data is going to be the biggest challenge we're going to face in 10 years' time. There is no storage. It ain't going to stay in the clouds because all that uncompetitive stuff is going to become a problem when everybody realizes how much they're being stolen from by the 4 or 5 incumbents with all of the data that they're doing their LLMs on. Local data centers or AI centers are going to be the future. We're going to go heavy. We're still going to do all of our other stuff.
1 minute, maybe. Yeah, Gary, go ahead.
I mean, I don't know about real trends. I'm still going to look for the great founders. I'm going to spend time with people early so that they bring deals to me before they're in market. We're not going to chase what's happening. I mean, at one point, Google Glass was the thing, and if we had a Google Glass fund, we probably wouldn't have had a second fund. So, really, it's about the founders for us.
30 seconds.
Yes, go ahead.
So I'll say on a sort of micro level, I think the feeling is fairly bullish among investors like myself. There's, I think, a misperception that the last couple of years and the lack of funding was because investors like me were not interested in investing. Wasn't the case. There was nothing really good to invest in. Companies were just not coming to market. Huge pent-up demand for good opportunities, and I'm seeing that now in Q1 as founders are getting swamped. The deals are competitive. Good companies are getting funded. On a macro level, I do not think it's implausible that we are on the cusp of what we might one day regard as a golden age.
So I guess
See, that's positive.
yeah. Well done. Let's give a great round of applause. I think this was a fascinating conversation.